Hello everybody, welcome to the second session in my video series about investment management fees. During the last session, I talked about what investment managers do and how they charge for it, introducing the concept of internally and externally charged fees. Given that, as I mentioned in the previous session, internally charged fees cannot be varied, in this session I'm going to be looking at fee methodologies that can be applied when looking at externally charged calculations, as well as how internally charged fees are dealt with within that context, and finally, what minimum fees are and how they're applied. In order to provide a framework for this and future sessions, I'm going to take the illustrative example of Acme Investments, a fictional UK domiciled firm that's decided that they want to invest £100 million with an investment manager. Following initial conversations with the client, the investment manager has established the following. First of all, that the best way to meet the client's objectives is to build a portfolio consisting of a mix of securities and investment funds. Secondly, that the client is looking to make the investment in several tranches, with the £100 million they've committed to investing being provided to the investment manager over an 18-month period. Thirdly, once the £100 million has been provided, that there are no plans to make additional contributions, with the expectation being that the assets will be withdrawn approximately 5 years after the date of initial investment. Finally, that it's important to the client that their fee is predictable, and that, based on the assets involved, they would be comfortable paying a fee of approximately £500,000 per annum. Now, let's take a look at some of the methodologies that could be used to calculate the client's fees, and based on the above, which of those fee methodologies works best from both a client and an investment manager perspective. Let's start by looking at fixed fees. Here, a fixed fee value is charged to the client, regardless of the total value of their investments, and is shown in client investment management agreements using language similar to that shown below. The use of this fee structure works well from a client perspective, as it provides them with complete certainty as to what they're going to pay. However, it also carries significantly more risk than other fee structures. Firstly, as the fee is shown as a fixed value, the impact of inflation means that, over longer periods, the real inflation-adjusted value of that fixed fee will fall, resulting in a drop in investment manager revenue in real terms. Secondly, even ignoring the impact of inflation, the static nature of the fee itself creates challenges. To start, let's look at the risk from an investment manager perspective by comparing it to a flat percentage-based fee structure, with the percentage rate chosen such that the total fee, based on the value of the client's proposed investment, is the same as that charged based on the fixed annual rate. If we apply a fixed fee, as the value of the client's holdings increases, a gap starts to appear between the fee based on the fixed fee and that had a flat fee rate been applied, with the gap representing the revenue risk involved in accepting the use of the fixed fee. This is an issue not only for the investment manager, but also for the client, as having the fee remain static reduces the financial incentive for the investment manager to grow the value of the client's investment. Now, there is an argument that applying a fixed fee also creates client risk, particularly where the client doesn't invest all of their assets at once, but instead builds up the value of their investment over time, and that the two balance each other out to some extent. But in my view, this argument is flawed. First of all, the client has control over the value and timing of their investments, meaning that they tend not to agree to this structure if they're planning to invest in tranches. Furthermore, should the value of their investments increase, they are incentivized to invest more, as there is no additional cost to them for doing so. Conversely, if the value of their investment falls, they have the option of either coming out of the investment completely, or, if they don't want to do that, to negotiate a lower fixed fee rate based on the investment manager's poor performance. As a result, fixed fees are mostly used where the investment manager is also receiving additional revenue from within the holdings covered by the fixed fee rate, and where an increase in the number or value of those holdings doesn't require any additional work on the part of the investment manager. And even then, they need to be monitored and may need to be periodically renegotiated to reflect the impact of inflation over time. Next up for discussion is a flat percentage-based fee, which is shown in client investment management agreements using language similar to that shown below. This is the simplest of the percentage-based fee structures, and the fee scales up and down linearly as the size of the client's investment changes. That said, this structure is not without issues, namely that it's based on the assumption that the amount invested will remain within a certain range, in this example between 75 and 125 million. This is an issue as, based on an investment value of below 75 million, the 50 basis point rate may not be offered to the client, and conversely, clients investing more than 125 million may be offered lower fee rates than the 50 basis points that would be applied in this example. Now, that's not to say that this is always a problem, or that the range that the rate is applicable to is as narrow as is shown here, but there are alternatives that can address this were it to be a concern. The first of these is to apply a tiered fee scale. Fees calculated using a tiered fee scale also scale up and down depending on the value of the client's investments. However, unlike fees calculated using a flat fee scale, the fees don't scale linearly, with different rates being applied to different portions of the client's investment value. Calculating the fee in this way means that the blended rate, which is the annual flat rate that would have to be applied to the full value to generate the same total fee, drops as the investment size increases. Taking the example of a £50 million investment and applying the tiered fee scale, we can calculate the blended fee rate as a value of 0.65% per annum. And, repeating this calculation at £50 million intervals, we can see that this blended rate continues to fall as the total investment value increases. But what if the client doesn't want a gradual change in rate? Well, then they might want to consider using a conditional or threshold-based fee structure. This structure is less common than the others and is similar to a flat fee, but the rate only remains constant within a range, and once the investment value moves outside that range, the rate applied to the total investment value changes to that applicable to the new range. The issue with this structure is that if the investment value hovers around the threshold of a fee range, the fees can vary significantly between investment periods. This means that were, based on the fee scale shown below, the value of the client's holdings to drop from 101 million to 99 million, as well as the drop in valuation, the client would also see an increase in annualised fees from approximately £400,000 to approximately £600,000. As a result, this structure can only really be recommended if the client expects to move firmly from one range into the next. In addition, when looking at tiered and conditional fees, it's worth highlighting that, unlike flat fees, both offer the client reductions in overall fee rate based on the total value of their investment. This means that if a client holds multiple assets with similar tiered or conditional fee rates, they may want to consider aggregating them if it's possible to do so. To illustrate, let's imagine we have a client who holds two funds with £20 million invested in each. They're charged separately at the asset level based on tiered fee scales, with the first £15 million being charged at 8 basis points and the remainder being charged at 4 basis points. Looking at a simplified calculation, the annual fee for each would be as follows. However, if the client negotiates the use of an aggregated fee scale, the wording in their agreement and the associated fee calculation changes. As you can see, the wording now states that the fee is calculated based on the aggregated valuations of funds 1 and 2, and the calculation reflects this, adding the valuations together before putting the combined value through the tiered fee scale. This results in a lower total fee, which can then be apportioned between the two funds based on the percentage of the total aggregated value invested in each. We've now discussed 4 different fee methodologies, as well as fee aggregation, which can be applied to either tiered or conditional fee scales. Now let's look at them through the lens of Acme Investments, keeping the following client requirements in mind. We'll start with conditional fees. So, are these suitable for the client? Well, it depends on where the range was set, but let's say, for example, the range for the lower fee started at 100 million. In this instance, the client's fees over the initial 18-month ramp-up period would be charged at the higher rate, as they would not yet have invested enough to meet the 100 million threshold value, so not great based on how they plan to invest. Also, given the value invested is set at 100 million, the fee rate based on that value is unlikely to be much better than the flat rate that could need negotiated for it, so the client is unlikely to see much benefit from the structure. Added to which, the fact that they would be at the edge of a value range would mean that their fees could vary significantly between periods, as market movements switch them between the higher and lower rates, meaning that their fees would not be as predictable as they would like. So a conditional fee scale is unlikely to work for the client. But what about a tiered fee scale? Again, as the client plans to invest in tranches, the fee over the initial 18-month ramp-up period may be higher than they might like, so not ideal. Also, as the expectation is that the investment value will not increase significantly beyond the 100 million, the client may not see the benefit from the fall in the blended rate beyond that point, and given that the portfolio will only be held for 5 years, it's by no means certain that the lower blended rate, due to expected investment growth, will make up for the higher fees at the start of the investment period. On the plus side, fees will move smoothly with investment value, meaning that once the client has invested the full 100 million, they should be predictable and are unlikely to vary dramatically between periods. So it's better than a conditional fee, but still not great. Next up are fixed fees. As these remain fixed regardless of the value held, the fact that the client is investing in tranches rather than all at once is going to mean that they are once again negatively impacted at the start. And given that the investment value is not going to be increased beyond the 100 million and is not going to be held for that long, meaning that there's not much opportunity for real-term fee reductions for inflation, they're not going to see much benefit from it over the life of the investment either. The fees will, however, be extremely predictable at a constant 500,000 per annum. Which brings us to flat fees. These are typically set on the assumption that the investment value will remain within a certain range, which, as the fee rate will have been set based on the expected 100 million investment, will mean that the client will effectively get lower fees during the ramp-up period. And, given that the investment is only expected to be held for 5 years, it's unlikely that any increases due to investment growth will take them to an investment value at which they would want to renegotiate the rate. Finally, as the investment value is expected to stay stable, the fee should be relatively constant and predictable over the life of the investment. Which, all in all, means that, given what Acme is looking to do, a flat fee offers them the best solution. Following previous discussions, let's imagine that Acme have decided to opt for a flat fee rate of 50 basis points per annum. They've also expressed an interest in investing 25 million of their 100 million total investment into one of the investment manager's funds. But, unfortunately for them, the share class they're looking at is internally charged at a rate of 75 basis points per annum. What does that mean for them? Well, as mentioned previously, where an investment fund is internally charged, there's no way to stop the fees from being taken from within the fund, so they need to be taken into consideration when determining the client's total fees, with a treatment that is to be applied being clearly set out in the client's investment management agreement. There are 3 options. The first is to double charge the client. This means that the portfolio fee is calculated based on the full 100 million value of the client's portfolio, which includes the 25 million investment in the internally charged fund. And, in addition to the portfolio fee, they also pay the fee within the unit price of the internally charged fund held by the portfolio, meaning that the total paid by the client, which is the sum of the portfolio and internally charged fees, comes to £687,500. This is, unsurprisingly, the most expensive of the 3 options from a client perspective, and its use is typically limited to where either the fund in question is managed by a third party, so while the client is paying fees twice, they're not paying them to the same investment manager, or the portfolio fee is for using the underlying assets as building blocks to maximize overall return and does not include the investment management fees charged in relation to those building blocks. The second approach is to rebate, a process which involves calculating the fee based on the full value of the client's portfolio and then reducing it by the annual management charge, or AMC, levied within the client's holdings of the internally charged fund over the invoice period. This means that, once again, the portfolio fee is calculated based on the full £100 million value of the client's portfolio, and that the client pays the fee within the unit price of the internally charged fund. But when it comes to calculating the invoiced fee, the calculated portfolio fee is reduced by the value of the internal charges the client has already paid within their holdings, with this reduction being the rebate. As the impact of the rebate and the internal charges cancel out, this means that the total paid by the client is equal only to the portfolio fee of $500,000. It's worth noting that if the internally charged fee exceeds the portfolio fee, the invoiced fee can become negative, with any such negative typically being paid into the client's advised bank account. Rebates are common in Europe, the Middle East, and Asia, but are not used in the Americas due to regulatory restrictions. It's also worth noting that as rebates are based on internally charged AMCs, they can only be easily applied if the fund in question charges based on a fixed AMC rate, rather than based on a fixed total expense rate. The last approach is to exclude, a process which involves subtracting the value of the client's holding of the fund from the value of the portfolio prior to the calculation of the portfolio fee, with the client paying both the fee based on the reduced portfolio value and the fee within the underlying fund. This means that before calculating the portfolio fee, the 100 million total is reduced by the value of the 25 million investment in the internally charged fund. The client then pays the fee within the unit price of the internally charged fund, and the total paid by the client, which is the sum of the portfolio fee calculated based on the reduced valuation and the internally charged fee, comes to £562,500. Exclusions are typically used where either rebates are not an option due to regulatory restrictions or because of the way the fund in question charges, or the fund held has a high internal charge and the investment manager doesn't want to effectively discount that rate down to that applied to the portfolio. Of these three options, from Acme's perspective, rebates are the best solution, so let's assume that's what's agreed here. Finally, let's close out the session by talking about minimum fees. The process of onboarding a new client is not without cost to the investment manager. They need to pay a number of upfront expenses, including legal costs and account opening charges, not to mention the cost of the time they actually spend designing investment solutions for clients. Furthermore, even once clients have been onboarded, there are ongoing reporting and administrative costs that need to be covered. These are usually paid out of the investment management fees, but where percentage-based fees are applied, should the value of a client's investments fall significantly, the fees generated based on those lower investment values can be insufficient to cover the manager's expenses. In order to make sure that costs are covered, investment managers commonly include minimum fee clauses in the client agreements. To illustrate, let's look at a simplified example. Here we have a client with a simple flat fee. Now, let's imagine that running this client's portfolio is an expensive process and that the investment manager needs annual revenue of $250,000 just to cover their costs. If this is the case, the investment manager can include a minimum fee set at this level based on the following agreement language. If at any point the value of the investment falls to a point at which the revenue generated would fall below the minimum, the investment manager can then calculate a minimum fee shortfall adjustment, which is charged to the client along with the base fee, making the total paid by the client the minimum fee level. It's important to note that a minimum fee typically covers all revenue retained by the investment manager, and therefore is applied based on the value of the fee before any rebates. In addition, estimates of fees charged within excluded fund holdings can also sometimes be included with the fee when determining the value of any applicable minimum fee shortfall. So, finally, let's quickly go through what we've covered today. We've covered that fees can be calculated based on a number of different fee methodologies, including fixed, flat, tiered, and conditional fee scales. We've looked at that when a client holds an internally charged fund managed by the investment manager, the treatment of fees within that holding needs to be considered and what the options are. And finally, we've looked at what minimum fees are and how and why they can be applied. So, all that's left for me to say today is to thank you all very much for your time and attention, and that I very much hope that you've found this session useful.